Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Inflation Survival Guide, protecting your finances from rising costs. Strategies to hedge against inflation. Investing in TIPS. Treasury inflation-protected securities TIPS provide investors with a guaranteed real return above inflation, making them a popular choice for hedging against rising prices. These bonds adjust their principal value based on changes in the Consumer Price Index. Real estate investments. Investing in real estate properties, or REITs, can offer protection against inflation by providing rental income that tends to increase with rising prices. Real estate assets have historically outpaced inflation over the long term, making them a valuable addition to a diversified portfolio. By understanding how different asset classes are influenced by inflation and implementing effective strategies like investing in TIPS or real estate, individuals can safeguard their investments against the erosive effects of inflation, ensuring long-term wealth preservation and growth. Inflation risk in personal finance. Inflation is a critical factor to consider when managing your personal finances. It can erode the value of your savings, impact your retirement plans, and affect how you manage your debts. Understanding how inflation risk influences various aspects of your financial life is essential for long-term financial security. Inflation and savings. When it comes to saving money, it's crucial to account for inflation. Over time, the purchasing power of your money decreases due to rising prices. To combat this, consider investing in assets that provide returns that outpace inflation, such as stocks or real estate. High-interest savings accounts or certificates of deposit can also help mitigate the effects of inflation on your savings. Inflation and retirement planning. Inflation poses a significant threat to your retirement savings. Failing to factor in inflation when planning for retirement can lead to a shortfall in funds when you need them the most. To safeguard your retirement income against inflation, consider investing in inflation-protected securities like TIPS, Treasury inflation-protected securities, or diversifying your retirement portfolio with assets that have historically outpaced inflation. Debt management in an inflationary environment. Managing debt in an inflationary environment requires a strategic approach. As inflation rises, so do interest rates, making it more costly to carry debt. To navigate this challenge, focus on paying down high-interest debt first and consider refinancing to lock in lower interest rates. Adjustable rate loans may offer a buffer against rising interest costs, but be mindful of potential payment increases as inflation climbs. Understanding how inflation risk impacts your personal finances is crucial for making informed financial decisions. By proactively addressing inflation in your savings, retirement planning, and debt management strategies, you can better position yourself for long-term financial success. Mitigating inflation risk requires a proactive approach and a sound financial strategy. Here are practical tips to help you navigate and counter the impact of inflation risk effectively. Diversification and inflation. Diversification plays a pivotal role in safeguarding your wealth from the effects of inflation. By spreading your investments across different asset classes such as stocks, bonds, real estate, and commodities, you can reduce the overall risk in your portfolio. In times of inflation, certain assets may outperform others, providing a buffer against purchasing power erosion. Maintaining a diversified investment portfolio is essential for long-term wealth preservation. Each asset class reacts differently to inflationary pressures, ensuring that your overall portfolio remains resilient in variable economic conditions. By leveraging diversification, you can navigate the changing tides of inflation and protect your financial well-being. Continuous learning and adjustment. In the realm of finance, continuous learning and adjustment are key components of staying ahead of inflation risk. Educating yourself on economic trends, monetary policies, and inflation indicators empowers you to make informed decisions about your investments. Stay informed about market developments and seek professional advice when needed to adjust your financial strategies accordingly. Flexibility and adaptability are essential in mitigating inflation risk. By regularly reviewing and adjusting your investment portfolio to align with changing market conditions, you can proactively counter the impact of inflation on your finances. Embrace a mindset of continuous learning and improvement to navigate the ever-evolving financial landscape successfully. Understanding inflation risk is crucial for your financial health. We've covered what inflation risk is and why it matters. We've also looked at ways to manage it, like diversifying investments and keeping a close eye on your budget. Don't ignore inflation risk. It can erode your purchasing power and savings over time. By taking action now, like consulting with a financial advisor and making smart investment choices, you can protect your future. Take control of your finances. Be aware of inflation risk and make informed decisions today to safeguard your financial well-being. Investing wisely is crucial. Historically, certain asset classes have outperformed inflation, preserving and even enhancing the value of investments over time. Stocks are a primary example. Equities in well-established companies, particularly those with strong pricing power, can provide returns that outpace inflation. Companies in sectors such as technology, healthcare, and consumer goods often have the ability to pass increased costs on to consumers, maintaining profitability and offering robust returns to investors. Real estate is another solid hedge against inflation. Property values and rental incomes typically rise alongside inflation, making real estate investments a reliable store of value, whether through direct property ownership, real estate investment trusts, REITs, or real estate crowdfunding platforms. Incorporating real estate into your investment portfolio can provide a buffer against rising prices. Commodities like gold, silver, and oil have also been traditional hedges against inflation. These tangible assets often appreciate in value during inflationary periods, providing a counterbalance to declining purchasing power. Additionally, investing in commodity-focused mutual funds or exchange-traded funds, ETFs, can offer exposure to these assets without the need to physically store them. Diversification remains a cornerstone of a sound investment strategy. By spreading investments across various asset classes, you can mitigate risks and reduce the impact of inflation on your portfolio. A diversified portfolio might include a mix of stocks, bonds, real estate, commodities, and possibly international investments, as different regions experience inflationary pressures differently. Another essential strategy is to reassess your savings approach. Traditional savings accounts and fixed income investments often offer returns that fail to keep pace with inflation. Instead, consider inflation-protected securities, such as Treasury inflation-protected securities, TIPS. TIPS are government bonds that adjust their principal value with inflation, ensuring that your investment maintains its real value over time. Similarly, I-bonds, another type of U.S. government bond, offer interest rates that combine a fixed rate and an inflation rate, providing a safeguard against inflation. Debt management is also critical during inflationary times. Fixed-rate debt can be beneficial because the real value of the debt diminishes as inflation rises, making repayments easier over time. Conversely, variable-rate debt can become more expensive as interest rates often rise with inflation. Prioritize paying off high-interest, variable-rate debt to avoid increased costs. Budgeting and expense management are fundamental to navigating inflation. Regularly reviewing and adjusting your budget helps ensure that you can cope with rising costs. Focus on reducing discretionary spending and finding ways to save on essential expenses. For example, buying in bulk, utilizing coupons and discounts, and prioritizing needs over wants can help manage your household budget more effectively. Maintaining an emergency fund is another crucial element of financial resilience. An emergency fund provides a safety net for unexpected expenses such as medical bills or car repairs without the need to incur debt. Aim to save 3 to 6 months' worth of living expenses in a liquid, easily accessible account. This fund can offer peace of mind and financial stability during inflationary periods. Understanding the broader economic environment is essential for making informed financial decisions. Staying informed about inflation trends, interest rate changes, and economic policies allows you to anticipate and respond to shifts in the market. Regularly consuming financial news, reading economic reports, and consulting with financial advisors can provide valuable insights. Inflation can also impact retirement planning. Traditional fixed income investments, such as bonds and savings accounts, may not provide sufficient growth to outpace inflation over the long term. Consider incorporating assets that offer higher potential returns, like equities and real estate, into your retirement portfolio. Additionally, delaying Social Security benefits can increase your eventual payouts, providing a higher income stream that adjusts with inflation. In conclusion, protecting your finances from inflation involves a multifaceted approach. Investing in assets that traditionally outperform inflation, diversifying your portfolio, managing debt wisely, budgeting effectively, maintaining an emergency fund, and staying informed about economic trends are all essential strategies. By implementing these measures, you can safeguard your financial well-being and navigate the challenges posed by rising costs more effectively. Adapting to inflation requires proactive planning and a willingness to adjust your financial strategies as needed, ensuring long-term financial health and stability. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.